In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how Bajaj Finserv and Allianz are finally ending their partnership after almost 25 years and what all of this means for the insurance space of India. And in the second story of the day, I'll talk about China yet again and we'll analyze whether or not their economy is really in a decline like many people say. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories for you in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 19th of March. See, recently there was a huge piece of news from the insurance industry. Bajaj Finserv and Allianz, who have been partners for nearly quarter of a century, are now ending their partnership. Now, for your context, Allianz is a major insurance company from Germany and it currently holds a 26% stake in two Indian joint ventures, which is Bajaj Allianz Life Insurance and second is Bajaj Allianz General Insurance. But it now plans to sell both of these stakes to Bajaj Finserv for about 24,180 crore rupees. And once that happens, both of the life insurance and general insurance businesses will be fully owned by the Bajaj Group. Now, at the surface of it, I know this may seem like a very regular corporate announcement like we see very often nowadays. But the thing is, this is quite a notable event for the insurance industry, and that is why in this episode today, we will analyze exactly what's happening here. See, long-running partnerships don't usually collapse for trivial reasons, and deals worth tens of thousands of crore rupees are not really casually drawn up, right? And this story did not come about overnight as well. It has been building for many years, and it has been shaped by changes in government regulations and also the way India's insurance market has evolved ever since the 1990s. See, for a very long period of time, India's insurance sector was mostly in the government's hands. Life insurance was dominated by the Life Insurance Corporation, which is LIC, while general insurance was controlled largely by the General Insurance Corporation. But when India moved towards liberalization in the 1990s, the government created the Insurance Regulatory and Development Authority, or the IRDAI. Here, instead of trying to run the entire insurance market by themselves, they basically allowed private players to start setting up insurance companies under the watchful eye of the regulator. But there was a challenge here. India did not really have enough experience in building and managing private insurance businesses, especially on large scales. And on top of that, insurance ventures required substantial capital, which was not really easy for Indian businesses to raise at that point in time. So the government allowed foreign companies to invest in these new insurers, but they set a strict cap on how much they could own. Initially, no foreign company could own more than 26% of an Indian insurance company. Now, the overall idea here was that foreign partners would bring in not only money, but also the technical know-how that is required to run modern insurance operations, while Indian partners, on the other hand, would contribute their knowledge of the local market and their connections on the ground. Now, Allianz was one of the first foreign insurers to see this as a golden opportunity. So they joined forces with the Bajaj Group in 2001 to form what is called the Bajaj Allianz General Insurance and Bajaj Allianz Life Insurance. Now, Bajaj provided local business expertise and large distribution networks, while Allianz actually offered global experience in underwriting and insurance management. And both of these companies grew very quickly. Back then, Allianz also arranged for a legal clause which is called call option in the partnership contract, which would let it increase its stake at a predetermined price if Indian law ever allowed such a move. And over the next 2 decades or so, Indian rules on foreign investment in insurance shifted slowly but definitely. Political debates made it very difficult to change the 26% ownership cap for a very long time, but in 2015, the government decided to lift this cap to 49%. And then in 2021, they went even further and raised it to 74%. And by doing this, they basically signaled to foreign insurers that they could finally become more than just minority partners in their Indian ventures. They could basically actively control or even own most of an Indian insurance business if they could convince their local partners to sell them a bigger stake. Now, of course, many global insurers jumped into that opportunity. For instance, Generali from Italy raised its holding in its Indian joint ventures to 74%, and even RGS from Belgium did something very similar in its partnership with Federal Bank. Aviva from Britain also followed suit by taking its share in Aviva Life Insurance to 74%. So essentially, these companies went from being being junior investors of sorts to being nearly equal or even majority owners in some cases. Allianz naturally wanted the same thing for its Indian operations as well. But they found out that Bajaj was not really willing to sell more shares to them. And unlike smaller or newer Indian insurance firms that might have needed foreigners to help them grow, Bajaj has actually built a strong and profitable business over the years, and they saw very little reason to give up its position of control over here. And to give you a point of reference, by the end of 2023-2024, the Bajaj Allianz General Insurance venture commanded 7.3% of India's general insurance market, while the life insurance arm held a 5.8% share. And both of them had been posting healthy growth in their new business premiums, about 33% for general insurance companies and 21% for the life insurance company. And on top of that, both had great solvency ratios, which are basically measures of their ability to meet policyholder claims. And these strong numbers basically meant that Bajaj felt very confident in the value and success of its insurance ventures. But the thing is, from Allianz's perspective, being stuck with only 26% meant that it had to watch Bajaj make all the key decisions. And Allianz basically no longer wanted to remain a silent partner in such profitable companies, especially when the law allowed it to hold a much larger stake. Now, reports suggested that Allianz looked into buying more shares using the call option that it had negotiated many years ago, but strict pricing rules from the RBI made it really difficult to carry out that in a way that Allianz found favorable. And it seems like the negotiations over these years did not really solve this pricing issue either. Bajaj refused to sell a greater stake at a discounted price, and Allianz refused to buy unless the terms were favorable to them. And all of this led to repeated deadlocks. By late 2022, it was very clear that the disagreements were too deep to patch up. Allianz started exploring its options, including the possibility of completely exiting these joint ventures entirely. Some rumors suggested that it might join forces with Jio Financial Services, or maybe even buy an existing but smaller insurance business outright so that it could have a much larger controlling stake and completely run the company the way it preferred. Finally, by January of this year, the partnership had unraveled to the point where the only question left was how Allianz would exit and on what financial terms. Now, those terms are now set. Bajaj Finserv has agreed to buy Allianz's stakes for about 24,180 crore rupees, pending approval from regulators like the Competition Commission of India and the IRDAI. And once this deal goes through, both Bajaj Allianz Life Insurance and Bajaj Allianz General Insurance will be fully under the Bajaj umbrella. Bajaj's chairman and managing director Sanjeev Bajaj expects this single ownership across both life and general insurance to create new ways of strengthening the group's position in financial services. And even though Allianz will walk away from its existing ventures, it has made it very clear that it is not really leaving India for good. The company acknowledges that this country is one of the world's fastest growing insurance markets, with foreign ownership rules now allowing up to 74% and future talks hinting that 100% might become possible. Allianz basically sees a chance to set up an operation in which it can have far more control and flexibility. In a public statement, Allianz said that it plans to reinvest the money that it receives from Bajaj into potential new opportunities in India. Future regulations may even introduce composite licenses, which could basically merge general and life segments into one single company, which could remove the need for separate entities altogether. And if and when that happens, it might actually lower the operating costs and let insurers offer full range of services under just one roof. This story is therefore not just about the breakup of a long partnership, it is also a part of a bigger trend in Indian insurance, where foreign insurers now have the legal freedom to demand a greater share in their joint ventures or even buy out local partners entirely. But that said, many Indian companies feel very confident to run things themselves after many years of learning the trick of the trade. They don't always need foreign support as desperately as they did once upon a time, and this has led to more friction when foreign insurers want to buy bigger stakes. So with that, let's move on to the next and the final story of the day and talk about China once again. Now, I know in the recent times there has been a lot of focus on China, but the thing is, whatever happens there seems to really move the needle for everyone else across the globe. Whether it's trade, technology, or even commodity prices, the thing is that developments inside China starts to send ripples across the entire world. Analysts keep talking about it partly because of its ongoing rivalry with the United States, which many people see as a defining geopolitical and economic story of our era. Basically, China is so powerful that when it slows down, markets get jittery. When it speeds up, companies scramble to keep up with the changes in supply chains. And that is why stories and case studies about China crop up so frequently, including the one which we just did in the previous episode. So with that context in place, let's understand what's happening this time around. See, right now, experts are grappling with what they describe as a paradox in China's economy. On one side, there is very clear evidence that the country's overall growth had slowed to levels that has not been seen in decades, at least outside of the pandemic. And on the other side, there is a remarkable boom happening in sectors like EVs, batteries, and solar panels. Now, three analysts, Gerald DePipo from the Rand Corporation, Yuan Ang of Johns Hopkins University, and Louis Vincent Gave of Gavical Research have looked at this from slightly different angles. Each of them point out that while China may no longer be barreling forward on the path of fast economic expansion, it has at the same time built a new economy that is now at the forefront of certain advanced technologies. So to truly understand the scale of the slowdown that we're talking about, let's quickly take a look at the official growth data. See, in 2024, China reported 5% real GDP growth, but its nominal GDP growth, which is basically another measure that captures the actual value of the economy, came in at only about 4.2%. Some private research groups like the Rhodium Group believe that the real figure might have even been lower in the range of about 2.4% to 2.8%. Not too long ago, the idea that China would soon overtake the United States in total GDP was treated almost like a given fact. But still, these days those projections have been pushed back by years or even decades if they happen at all in the first place. A part of the reason is that property, which once drove about a quarter of China's economy, has stumbled quite badly. Back in 2020, Beijing introduced 3 red lines policy to keep real estate companies from drowning in debt. And while that policy may have been well-intentioned, it basically ended up setting off a painful correction in the property market. Since there was no clearly laid out plan to manage this downturn, the damage spread very quickly. Developers went under, projects stalled, and the overall economy lost a big driver of their growth. But the thing is, at the exact same time, there is an entirely different story that is playing out in China's high-tech industries. See, while investment in property fell down, investment in areas like semiconductors, EVs, and even batteries shot upward even during the tough years of the pandemic. China is now a global leader in exporting what some people call the new trio of advanced products, which is electric cars, lithium-ion batteries, and solar panels. This surge is impressive and shows that China is not a one-dimensional economy that only depended on real estate. However, these new sectors, large as they are, still make up a relatively small size of less than 20% of China's GDP. So as one analyst points out, even though these emerging industries are growing quite fast, they are not yet big enough to cancel out the slump in more traditional areas. It's almost like having two different economies running side by side, a sluggish old-fashioned one that is losing steam and a cutting-edge one that is firing on all cylinders of sorts. But digging a little deeper into why the old economy is left floundering while the new economy is booming, some experts say that it has to do with the way China's politics and bureaucracy work. Yuan Ang suggests that China is not a simple command economy where leaders precisely dictate every single policy. Instead, she describes it as direct improvisation, which means the central government signals big goals like high-quality development or new high-tech industries, and then local officials and business leaders rush in order to meet these goals because they believe that's where their political and career incentives lie. And in this framework, helping the old property-heavy economy might seem like a career dead end, especially if the top leadership has decided that the future belongs to technology and clean energy. And this could very well explain why we have not really seen a big rescue plan for real estate in China and why local governments over there often go overboard in propping up favored sectors. Sometimes this process leads to wasted effort or inflated figures such as the countless junk patents produced when local officials were told that boosting patent numbers equaled innovation. It is also why the electric vehicle industry is brimming with hundreds of car factories, even though many of them are operating at very low capacity and will likely vanish in the coming few years. But still, from the government's perspective, even if 9 out of 10 ventures fail, the one that succeeds might become a global champion just like BYD, and that is often enough for them to justify a lot of waste. Louis Vincent Gave brings in another perspective here, and he notes that starting around 2018, China seemed to shift capital away from real estate and poured it into manufacturing and technology instead. Now, part of the trigger here was Western sanctions and the growing fear in China that access to vital imports could be cut off. And this spurred what Gave calls the Hunger Games capitalism, where dozens, if not hundreds, of companies in the same field fight intensively for survival. And while this environment can look chaotic from the outside, what it has done is that it has helped China rapidly build up expertise in everything, right from solar panels to advanced car batteries. Also, China's trade surplus has hit a record level of around 1.1 trillion US dollars. But that money flowing into China is not being invested into real estate or stocks as much anymore. And this is, of course, partly because businesses feel very uneasy about the uncertainty around tariffs and other external pressures. As a result, a lot of cash actually ends up in banks, which pushes interest rates and bond yields very low, down to around 1.6% in many cases. Some observers also compare this situation to what Japan went through in the 1990s when its economy slowed down despite having some groundbreaking technology. However, Gave argues that China's record surplus and its fierce global competitiveness make that comparison very less convincing in these days. So in the end, it is very hard to classify China as simply declining or simply roaring ahead in that case, because both narratives have real evidence behind them. The property sector is weakening and its overall GDP figures are not really as dazzling as they once used to be. But at the very same time, it is super hard to ignore the rapid gains in cutting-edge industries. Even if consumer confidence takes a hit and many investors stay cautious, China's manufacturing power in electric vehicles, solar panels, and batteries keeps rising. Many analysts say that China is simultaneously slumping and thriving. That brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, SpiceJet's promoter Ajay Singh is injecting 294 crore rupees into the airline by converting 13.14 crore warrants into equity shares. This raises the promoter group's stake from 29.11% to 33.47%. Simultaneously, Singh has offloaded 2 crore shares in the open market for 90 crore rupees at an average price of 45 rupees per share and is in the process of selling an additional 3.15 crore shares to partly fund the remaining 75% of the warrant conversion cost. Second, State Bank of India has postponed its planned 15,000 crore fundraising to 2026, citing elevated bond yields. The bank had an approval to raise 5,000 crore rupees through additional Tier 1 perpetual bonds and 10,000 crore rupees via 15-year infrastructure bonds, but they decided to delay due to a 15 basis point rise in AAA rated 10-year corporate bond yields since the month of February. Third, Tata Sons has acquired an additional 10% stake in Tata Play from Temasek Holdings affiliate Baytree Investments. This raises its total stake to 70%, while Walt Disney retains the remaining 30%. Now, this move comes in as Tata Play and Airtel Digital TV explore a potential merger which could create a 1.6 billion US dollar entity in India's 60 million DTH market. That's all the news and stories I have for you today. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.